Hey friends, welcome back to my channel. If you're new here, my name is Bianca, and today we are going to dive into a question that is crucial for anyone who is interested in real estate investing. So essentially, how do REITs, or any real estate investor essentially, value commercial real estate? So just a bit of a quick recap, real estate investment trusts, or REITs, are essentially a bit like exchange traded funds or ETF, but for buildings. Instead of holding stocks or bonds, REITs own income-generating properties such as office buildings, shopping malls, industrial warehouses, or even data centers. And they allow everyday investors such as you and I to pool our money together in order to invest in a large-scale commercial building without actually having to buy the physical property outright. But here's the big question. How do REITs actually determine how much these properties are worth? Because trust me, it's definitely not as simple as looking at the price tag of a random grocery item. Commercial real estate valuation is a nuanced process that involves multiple methodologies, each with their own set of strengths and limitations. In this video, I'm going to walk you through the three primary methods that REITs use to value commercial real estate, namely the cost approach, the market approach, as well as the income approach. And by the end of this video, you shall hopefully have a decent understanding of how these three methods work and why they are so important in the world of real estate investing. So let's get on to it. But before we dive into the details, I want to take a moment to emphasize something important. Valuing commercial real estate is a highly specialized field that requires deep expertise as well as access to detailed data. In translation, people do actually work full-time in this field. So the information I'm sharing today is meant to provide you with a very high-level overview, and it's purely meant for educational purposes or entertainment if you find it entertaining. So the information I'm about to share should never be taken as investment advice or professional valuation guidance. You actually need to go to a qualified professional for that. Alright, now with that out of the way, let's explore how REITs may value commercial real estate. So as how I mentioned earlier in this video, there are three main methods in which commercial real estate are valued, which is namely the cost approach, the market comparison approach, as well as the income approach. Each method has its own purpose and is applied in different scenarios. So let's just break them down one by one. Let's start with the cost approach. Now, the cost approach is based upon a very straightforward idea, and that is the buyer won't pay more for a property than it would cost to build something similar from scratch. This method can be useful especially for unique or highly specialized properties where there may not be many comparable sales to reference, and this could be the likes of schools or government buildings or perhaps even museum buildings. It can also be helpful for newer properties where the construction costs are way easier to estimate. Here's how it works in a bit more detail. So the first step is to determine the value of the land itself. So REITs can analyze recent sales of similar plots of land in that area in order to first establish a baseline. Adjustments are then made for factors such as location. So is this piece of land located in a prime downtown area, or is it in a less desirable neighborhood? Or such as the likes of accessibility, so is it close to major highways or perhaps public transport systems, as well as zoning restrictions. So can you just build whatever you want on top of it? Or are there like limitations? Next, you will need to estimate the cost of replacing that building. So this includes the construction cost, which is the likes of material, labor, and equipment, as well as professional fees, because you need to make sure that your architects or engineers are paid as well. And in addition to that, there are some miscellaneous expenses such as your permits, taxes, or perhaps any financing costs that are associated with this building project. And these replacement costs may vary significantly depending on, say, the type of building that you're building after all, the quality of the materials used, as well as the current market conditions, which may, let's just say, impact the price of raw materials. Following that, as much as how I would personally like for this to be the case, but unfortunately, no building will stay brand new forever. So you do need to take depreciation into account, and that includes the likes of physical wear and tear, or perhaps some features of the building that has become outdated over time, such as an inefficient layout or maybe technology that is no longer applicable. These adjustments ensure that the valuation reflects the property's current conditions and marketability. And finally, to close off the cost approach, all you need to do is to then add back the adjusted land value as well as the building value together to arrive at the property's total market value. Next in line, we have what is called the market approach. Well, some people do call it the market comparison approach or the sales comparison approach, or well, the comparison approach. But the notion is the same, and it's all about looking at the market to determine a property's value. Here's how it works. So the first step is to basically identify comparable properties, and that involves researching into what has been recently sold in the market that is similar to the building that you are trying to value. And ideally speaking, these comparables should be based in the same area as your building, as well as share similar characteristics in terms of its size, age, as well as functionality. But as I said, that's the ideal world. No two properties are exactly the same. So you gotta make adjustments to account for the differences. For example, if your property has more modern facilities or is just located in a more affluent region, well, adjust your value upwards. Conversely, if your property is in a far worse off condition, well, the value probably has to be adjusted downwards. So once you have analyzed and adjusted for all these differences, investors can then estimate the property's market value. As you can see, this method can be particularly useful if you're in a very active market with a lot of recent sales data. So that basically summarizes the market approach. Now, let's move on to the income approach. So the income approach is probably one of the most widely used methods to value commercial real estate. And it is the case for very good reasons. And it is based on a very simple idea, and that is the value of a property is directly tied to the income it is able to generate. After all, if a property is capable of generating a stable cash flow, it is inherently way more valuable to investors. So based on the notion that I've just shared, I think it's pretty clear as to why this approach is particularly applicable to income generating properties such as shopping malls, office buildings, or industrial warehouses, because rental income is a key driver to the property's value. Having said that, there are two main subcategories that fall under the income approach, namely the investment method as well as the DCF or discounted cash flow method. I will try my best to break them down step by step, but also just bear in mind that I have simplified some aspects of it in view of the general audience. So, number one, we have the investment method, which depending on where you come from, it may also be known as the direct capitalization method. And it is used for properties with stable and predictable income streams. In essence, this approach focuses on a property's net income followed by capitalizing it to arrive to a market value. Here's how it works. The first step is to determine the property's gross annual income, or the top line. And that includes the rent you collect from tenants, as well as any additional revenue streams, such as your parking fees, maintenance charges, event rentals, or perhaps signages or kiosks that you see in shopping malls. After that, investors will need to deduct annual expenses from the gross income. So these expenses could include the likes of property taxes, maintenance costs, insurance, or even the manager's fee. And the resulting figure would be your net income, which is essentially representing the cash flow that the property generates after subtracting all its associated expenses. Then, the final step is to convert the property's net income into the present market value using a market-derived capitalization rate, or aka the cap rate. So the cap rate is essentially a metric that measures the rate of return that is expected to be generated on an investment property. It is a critical metric because it accounts for risk and market conditions. So a lower cap rate would essentially imply that the property is inherently less risky due to its type, class, and market. In the meantime, a property with a higher cap rate would essentially offer investors a higher return, but as the saying is, high risk, high reward, so it would also imply that the property is inherently more risky. But now as we go back to determining a property's market value using the cap rate as well as the net income, the formula is pretty simple. You essentially just need to take the property's net annual income followed by dividing it by the cap rate to arrive to the property's market value. For instance, let's just say we have a property that generates $1 million in net annual income, and then we also know that the market rate is at 5%, then the property's market value is essentially calculated by taking $1 million divided by 5%, leaving us with a property's market value being $20 million. So that sums up the investment method. And now let's move on to the DCF method. So the DCF method is a more detailed approach, and it's often used for properties with more complex income streams or long-term lease as well as fluctuating cash flow. Unlike the investment method, which fundamentally relies on a single year's net income, the DCF method would value a property based on the present value of its future cash flows over a defined investment period. So typically it is like in the next 5 to 10 years or sometimes even longer for institutional assets. So here's how it works. So the first step of the DCF valuation process is to forecast the property's expected cash flow for each year during the investment period. So these projections would typically include the rental income, so basically the expected rental revenue that you're going to collect from tenants, well adjusted for lease renewals, rent escalations, or perhaps some market conditions. You will also need to make some projections for your operating expenses. Besides that, while properties will always have a risk of vacancy as well as credit loss, so you definitely need to account for lease expiration, tenant turnovers, or some potential non-payment of rent for whatever reason. Now, once the future cash flows have been projected, they will now need to be discounted back to their present value. And that's because a dollar received in the future will be worth less than a dollar received today due to, well, inflation as well as investment risk. And that leads us to talk about the discount rate, which is essentially the rate of return that investors require for taking on the risk of owning that property. And for this step, well, there are many ways that investors could determine their discount rate. For some investors, they may try to base their discount rate off what we call the weighted average cost of capital, or WACC, which essentially combines both the cost of debt that they have incurred as well as the cost of their equity. Alternatively, investors could also base it off an internal rate of return from comparable transactions. Or you could also opt for a risk-adjusted discount rate based on a few factors such as the risk-free rate, which basically translates to the government bond rates, as well as the market risk premium, or even property-associated risks such as the location, tenant creditworthiness, etc. So onwards to step 3, investors will then need to calculate a terminal value, which is basically the estimated value of the property at the end of that investment period. So the most common approach to determining the terminal value is to essentially apply the market-derived cap rate to the final year's projected net income. In simple English, essentially all you need to do is to take the net annual income and divide it by the cap rate, just like how we did for the investment approach. And this terminal value figure would essentially account for the property's long-term value beyond the projection period. So last but not least, once you have calculated each of the year's future cash flow as well as the property's terminal value, all you got to do now is to discount each projected cash flow, including the terminal values one, back to the present value using the following formula. Well, the formula is a little tricky for me to read out, so I'm just going to show it on the screen. But let's just walk through a quick example to give you an idea of how we could discount the projected cash flow for a certain year back to its present value. So let's just say you have a property that is expected to generate $1 million in cash flow in your 5th year, and the discount rate is 8%. Well, let's plug in the numbers. So the present value would essentially be taking your $1 million on top and divide it by 1 plus the discount rate, and then to the power of 5 because 5 years, and this will lead us to a total of $680,583 as the present value. So the income that you can expect from that property 5 years from now or today is worth $680,583 today. That was quite a mouthful. I have no idea why I picked those numbers for my example, but I hope you get the point. And once you have successfully summed up all the discounted cash flows as well as the discounted terminal value, you would then arrive at the total property value as your final figure. That essentially sums up the DCF or discounted cash flow method. Now, before I end this video, I think it might be useful to just bring up this discussion point, or at least a food for thought to consider, where I guess over the course of this video, you may eventually just realize that valuing a property is actually both an art and a science. It is an art in the sense that it requires a series of assumptions, estimates, as well as professional judgment. For instance, well, as you may have noticed earlier, how would you have determined the right cap rate to use? Or how would you account for your depreciation costs, as well as what discount rate you're going to employ in your calculations? These all require a fair bit of intuition as well as working experience that goes beyond, well, simple maths. On the flip side, valuation also has its sciencey aspects because they have its share of established methodologies such as the income approach or market comparison approach that we have discussed earlier, and all of which provides a structured framework in order for us to arrive to a figure. Plus, these methods are often used by professional valuers rigorously in order to establish credibility as well as accuracy in their estimate. But ultimately, the goal is to strike a healthy balance between these two aspects. By combining all these sound methodologies as well as thoughtful analysis, investors can then arrive to a property valuation that fairly reflects both the numbers as well as the nuances of the market today. With that, thank you all so much for taking the time to watch my video. I know it is still a fairly high-level overview, but I still hope that you found it useful as well as informative. And if you enjoyed it, please don't forget to hit the like, subscribe, and bell icon to support my channel. If you're interested in more content about real estate investing, you may be interested in the video I've made where I talked about how REIT managers pick the best properties to invest in. Until next time, take care and I shall see you in my next video. Bye bye!